Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, October 20th, 2020. What we'll do in this video is start out taking a look at the broad markets. We'll look at both the near-term outlook via the intraday charts, the 60-minute time frames, and I also want to look at the longer-term charts, daily and weekly charts, and we're going to cover QQQ, SPY, IWM, and then I'm going to go through probably not all of the 11 sectors in the S&P 500, but maybe the top 7 or 8. The reason being the bottom sectors such as utilities, real estate, the REITs and basic materials, they have such a low weighting in the S&P 500, it doesn't matter what they do. Those things can rally 30%. And if tech drops 10, the market's going to go down because tech has such a higher weighting than those all those three bottom sectors combined. Tech still dwarfs them. So it's all about simple mathematics. So real REITs can do whatever they want to do, but it's not going to move the needle on the S&P 500. All right, let's start out here with QQQ and let's pick up where we left off yesterday. Okay, kind of intermediate to near-term picture is, back up here we had a sell signal. We had the biggest correction since the March lows. That ended with bullish positive divergences right here with a little bullish falling wedge breakout, and it led to this uptrend. What I've been focused on a lot in recent weeks, and again this just kind of recap stuff for those catching up, is we had the top of the multi-week trading range right here from about 280 to 283 or so, capped by all these reactions here, and finally we broke out. So this was a breakout above that trading range, and this is simply a back test of the top of the trading range recently. So the bullish case can be made if you are wholeheartedly bullish and you believe the market's going to new highs and beyond. You're not concerned about the elections. I will say this is the second most objective long entry that I've seen in months, this being the most objective right here on the bullish falling wedge after the breakout and confirmed divergence right there, which was a catalyst for this rally. So again, breakout, back test, that's TA 101. If you caught the breakout, great. If you missed the breakout or you took profits on the initial leg up, this is your objective entry on a pullback. Bulls want to see that. Bears want to see that level fail, and fail with conviction. Like I said, it's more of a zone for me from about 282.71 down to about 282.30. So you can still see this to keep it bullish, but anything much more than that takes you back in the range, and once you re-enter a trading range, there's a good shot you're going back down to the bottom of the range and possibly more. So let's go back to more of a very micro view, and that would be where let's pick up where we left off yesterday. In yesterday's video, late in the day, I told you we were at support, not just here on QQQ. We were right here at this 282.71 level, and I showed you it was support on QQQ as well as IWM, as well as those big components of the NASDAQ 100 I covered, such as Apple and whatever else was there yesterday. And so therefore, I said the odds favor reaction, and I said a potential bounce target. I didn't think it was going to go far. That's what I stated at the time, and it was. It was only about 1.25% bounce on there. And I gave you a bounce target of this 285.79 level, and so that's what happened. We hit it. We hit it again, tried to break it intra-period, but didn't do it. Closed back below the range, hit it again, and we're trading there. So it's been a small micro trading range, and that's where if you're an active trader, now certainly worth gaming this. If you're an active trader, it's only about 1% or so top to bottom, but I don't have to tell you, if you trade NQs, the NASDAQ 100 futures, which are leveraged, you're going to make well over $1,000 on each round trip to the top and bottom of the range. And ultimately, trading ranges don't last forever. An upside break's going to be bullish. I added a level since yesterday to this chart. That's about 289.42. That would be a potential bounce target. Why? Well, it's the top of this gap right here from Monday before last. That's roughly the top of the gap. We also had a gap right there, and so it's the bottom of that gap. And you can see lots of candles reactions along that level, and so that would be a potential upside target should we break to the upside here. And again, a breakout would be a solid impulsive move For example, once we entered, broke below that gap right here, you can see this candle was the biggest candle that we've had since this one right here. It was an oversized candle. That's an impulsive drop. We followed up on the very next candle, hit the bottom of the range, which was support. So again, a solid breakout and or solid 60-minute close should do the trick, and it would be bullish. No guarantees, but that unless it fails like this, that would be your next upside target. So if you're an active trader, you could take the breakout if we get it, put a stop a little bit below your entry point and target that level. Or you can, of course, if you want to think the range is going to continue, I don't know. I'm kind of split on it right now, to be honest with you. But you could short right here with a stop somewhat above, and maybe there about 286.50 or a comparable level in NQ, and target for the move down to the bottom of the range. If we do happen to reverse, we've already hit the bottom of the range twice. My guess is we're going to go through, break it. If we reverse and go down, we'll probably break it and come on down to that 280.32 level. So those are your very near-term potential scenarios. Don't forget, you take a step back a little bit longer term, and you have a break of this trend line right here, and so far a move down, and there may be more to come there. Maybe not. You can look at it this way. If you step back and look at the move down off the recent highs, remember back then I told you we had extreme overbought readings, which are almost always followed by a correction. And so after the breakout, like I said, that was the next tradable trend. It was a nice run after the breakout, but we became extremely overbought. And so far that's played out in the form of an ABC corrective wave. If you're an Elliott waver, when you have a primary trend, which is this, at least in the intermediate term, there's your bullish trend off that divergent low. This could be an ABC corrective wave. So again, there's a lot here for a bull to say, okay, ABC corrective wave, it's over. We hit support, go long here. If we get another thrust down, it's still certainly possible. Like I said, it's the bottom part of the top end of that trading range is about 282.32. So if I were targeting a move to new highs right now, not that I am, but if I were, this is where I would have a stop somewhat below there, give it a little room, and if you think the market's going to go to new highs and beyond. As of now, we're still below those highs in SPY and QQQ. Speaking of SPY, let's look at that. We can turn off all the lines and show you that the top of the trading range on SPY was about right here. Again, that's once we entered that corrective mode, we had reactions at that level. There was our breakout, and same story, breakout, backtest, second backtest, and bulls want to see this, bears want to see that breakout fail. Which way? Well, I'm going to show you some charts that might give us some clues as to which way that's going to go. But of course, respect the levels. You're going to have your opinion on where we're going to go. I might have my opinion now, and that may change, and most certainly will change depending on what happens on the technicals. Let's talk about the S&P 500 futures. They have a nice, well-defined top of that trading range. Again, it's right here, 34.17. Look at all the reactions along 34.17. We had reactions back here, but once the correction started, boom, we hit it, bounced. Then we broke it, back-tested it, failed, back-tested, 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 back-tested. Boom, there's your breakout right there above the trading range. And again, back-test, backtest. So I've added a minor downtrend line here, which would be bullish if taken out on ES. And so again, we're at support. TA 101 says you either buy a pullback to support or wait until it breaks. So again, bears want to see a solid move back down there. Bulls want to see this level hold, whether or not it gets tested again. And then the next objective long entry would be a breakout above the this downtrend line right there. Oh yeah, and if I didn't mention it, which I don't think I did, I got to check this oversold reading. Remember, just last week or so, I pointed out this oversold reading, and I went through this chart and told you that I have my green line. This is not the typical oversold reading on the RSI, which comes in at 30 on most charting platforms. I use custom and every security is different. To me, QQQ or NQ, Nasdaq 100 futures, really become oversold when they hit about 87 on the RSI. That's when you want to stop going long and be, or take profits on your longs or look for shorts. With the oversold readings, usually you hit it and then you become a little less oversold, and that gives you the negative divergence. That's usually when the top comes. Again, hit the line there, and we did have a correction. Look, I mean, you can solely short just on tags at that level, but then it pushed up higher, made a divergent high right there, then another correction came. So either way, put the odds in your favor. There it is. That one nailed the top, and before all is said and done, we fell, about 15%. Now, likewise, those are your sell signals, or not sell signals. I need to be clear. I always say that overbought and oversold in itself is not a buy or sell signal, but it's an indication, a heads up. Hey, we're very overbought, we're very oversold. So if you weren't already long, not a good time to be adding longs when you get here. In fact, that's when you want to start looking to, for a reason to take profits, raise your stops, and or get ready to short, especially on something like a trend line break of a rising wedge like that. And flip it around this way. There's our oversold reading, about 27. That's the last time I pointed out there. There was certainly a tradable bounce to be made there. We had one there. Certainly a nice rally off that one. We had one here. Nice rally. Almost hit it there. Nice rally. Again, you get the picture. In a bull trend, those rallies are going to be a little bit longer, but even in a bear trend, we had some nice, tradable bounces every single time we hit that line. So again, I would be remiss not to point out this most recent tag, which also coincided with a fallback, a bounce or drop to that support level, and I have it at 11,607 or so on NQ. RTY, small cap futures, kind of grinding around lately. There's some resistance here at about 1634.37, but it's been chopped through quite a bit lately. We're at it again. We'll just call it for what it is. Resistance is resistance until unless taken out. I had a downtrend line here, and that's even gotten a little sloppy. But pretty much if you take that resistance level out and the downtrend line, that should be near-term bullish for IWM. Another rejection is going to bring us back down once again to that 1592-ish support right there. And I think that's if and when that level goes, that could be that would be actually a failed breakout. So there's a common theme here with QQQ, SPY, and IWM. This is, the futures for IWM. IWM's the ETF that tracks the Russell 2000. There's your breakout. It happened right here. You had previous highs here. And so bulls want to see us bust up above this trading range right here that we've been in since the breakout. Bears want to see the breakout fail. And so there's your, sell signals. And, if you can see this happen on IWM or RTY and QQQ and NQ and SPY and ES, all the better. Likewise, more upside breakouts in all those indexes are going to increase the odds of more upside in a vacuum. Now, in the real world, we're counting down the days to the election, November 3rd. I don't know how many trading days that is, but it's not many. I expect, volatility to spike up leading up to and shortly after the election, and that may lead to some whipsaw signals. Okay, therefore, let's take a look at a little bit longer term outlook. That was all 60-minute charts, very short-term micro levels for you active traders, swing traders, investors. Let's take a look at the daily chart. Lots of lines here on SPY. Forget about most of those. But what we have here is this uptrend line, which was recently broken. Again, that meshes with what you saw on the 60-minute chart. It's an uptrend line off the September lows, and there's a breakdown, back test, and a pretty impulsive rejection off the back test. And I have a line here at 339, which I think it was valid back then, but I also see some reaction highs right here. See those 1, 2, 3, 4, almost 4 candles, another one there. So I'm going to put that as a support zone right there, and that's where we're at on SPY. PPO has not crossed over, but it is curling down, and could make a bearish crossover. This is your PPO right here. Works very, very similar to MACD. They're close cousins. So watch for that. If we move down, to get a bearish cross is probably going to entail a break back down below those recent trading ranges, you know, the breakout level. So that's going to be pretty bearish if we get it. Last time we had a bearish PPO crossover, a clean one. I'm talking nice separation between the lines. I don't like when the lines are flat like this and you get, you know, a little whip. That actually bounced off it. So there was our last sell signal. That came right after our sell signal. Remember, we broke the minor uptrend line there. And again, it got you in short or got you out of your longs on the biggest drop since the March lows right there off the highs. We had one back here. There was a clean crossover right there, and there was, you know, more downside from there for a while. QQQ, similar comparable trend line right here. Our most recent trend line, which again was broken recently, and there's that top. That's also the top of that trading range. So basically what I just showed you on the 60-minute chart, trend line break, but we fell back to test the top of that trading range, and that is again from the correction there. And there was our nice sell signal way back then in early September. So that's it. Still below those recent highs. Back testing again. This is your bullish scenario, and this is your bearish scenario. And you know, as to which one happens, well, just wait and see. Wait, if you get a break, solid break below, much below 283, and I give you the, you know, kind of more micro honed in levels on the 60-minute chart. But the bulls, yeah, I can certainly make a case to step in long here with a stop below and just let it run. You know, let it in the trail your stops up and let it ride. One thing to note here, if we do turn down, if we fail to rally here, and especially if we break back down in that trading range, you are also going to have a bearish crossover. Nice clean one here. Again, it hasn't occurred yet, nor has a breakdown into the trading range occurred. But the last time we had one was right there. That was coincided with the sell signal we got on the break of that trend line, and again triggered the biggest, you know, signal the biggest drop in a while. Other than that, you know, we were in a very low volatility grind higher, and therefore the PPO line had kind of flattened out, and therefore those signals tend to be whipsaw signals. Again, you want to see clean separation between the lines. For example, here's a clean bullish crossover right there. It says get long. There was a bearish PPO crossover. It was a little bit better than it looked there. You have to zoom all the way in. I'd have to grab this and go, well, let me try it here 1 second. Bear with me. There we go. Okay, see, when you go back and you take away that big swoop down, you can see there was clean separation in lines. And again, that told you right after we got a sell signal on the trend line break there, that was that big drop into the March lows. It was not random. Yes, COVID certainly accelerated the drop, but it was technically induced, and it was confirmed too with the trend change on the bearish PPO crossover right there. Okay, and as I like to say, an index, or you know, the stock market, is simply a sum of its parts. And when it comes to the S&P 500, which is often referred to as the broad market, it's a much more diversified index than the NASDAQ 100 or QQQ. Much more representative of what's going on in the U.S. economy. QQQ is going to tell you what's going on in the tech sector because of the heavy tech weighting. But with that being said, even in the S&P 500, there are 11 sectors. The largest sector is the tech sector, and that is represented by XLK. These numbers are a little bit dated. I update them from time to time. So these numbers will change, but they're roughly, one thing is pretty much a constant in recent years, is that tech is by far the largest sector in the S&P 500. You know, back last time I checked this, it was a 25% weighting, so 1/4 of the returns from the S&P 500, and much more than that. It's like over half in the NASDAQ 100 comes simply from the tech sector. So you know, there's almost no way that the market is going to drop when the tech sector is going up, and likewise there's almost no way the market's going to go up when the tech sector is falling. So this is an important sector to watch. And then of this sector, again, this was as of June 15th, 2 stocks alone, just the first two top weighted components in there, Microsoft and Apple, make up over 42% of this sector. So it's really, again, you don't have to look at 100 stocks to try to figure out where the tech sector is going. You can look at two and figure out where it's going. That's Microsoft and Apple. There it is. Minor trend line break. There was a larger trend line break there. Where does it go from here? Well, pending bearish PPO crossover, just like at QQQ. No surprise. This chart's going to nearly mirror QQQ. So if we drop much more, then that is going to give us a bearish PPO crossover. What would be additionally bearish is if the PPO, bearish crossover is when the orange line crosses the white line. Then you have what they call a zero line cross. The zero line right here, the dotted line, differentiates and does a really good job at defining bull and bear trends. When the 90 MA is below the white line, the trend is bearish and you want to be short or out of your longs. When the line crosses above and stays above, the trend is bullish and you want to be long, as you did here. The zero line will often act as support or resistance when tested from above or below, as it did here, and it kept that trend intact during the correction, the primary trend. And so those are two of the big things to watch in the coming weeks. Both the bearish PPO crossover, if we get it, which we don't have yet, and then if we do we cross down below the the zero line? As of now, we have neither, so that keeps, at least by these trend indicators, they're both on buy signals, they're both bullish. And here's what XLK looks like on a weekly chart. This is the best trend line I can fit right now, and we're below it, and we broke that trend line there. We had negative divergence on the RSI before it happened at the last high, and it's just simply a kickback rally with more to come, or was it a little blip on the road to new highs? Well, one thing to note is if we do make a new high, and that would mean taking out that previous early September high, anytime soon, I'm going to draw, it's going to look like this. An equal or marginal new high will give us negative divergence. It'll keep the divergence on the RSI intact. It'll only extend it, and it'll also give us a negative divergence here on the PPO. So food for thought there. Next sector, and I'm going in order of weighting how they impact the S&P 500. That's healthcare at about a 16% weighting in the S&P 500. Well, what did we have here? Well, we had at the recent high, you can see right here, we had negative divergence. Just like we had negative divergence right here before that drop, that was a divergent high. We had negative divergence here before that drop. Again, telegraphed in advance with negative divergence. COVID certainly accelerated and magnified the drop. But, positive divergence is also marked here on the chart. That's when you want to go long. So that's it. So as of now, we made, let me zoom in real tight. We made roughly an equal high. I'm going to just put it like this. Here's your previous high, roughly an equal high, and that simply extends that divergence right there. So that divergence is intact. Any marginal new high anytime soon is simply going to extend the divergences as well. In other words, these divergences as of now are not at risk of being taken out anytime soon. We'd have to go substantially higher in XLV to negate those divergences. Weekly time frame, you can see clear big divergences on both the PPO and the RSI right here. This is how it works. Divergent high, correction, divergent high, correction, divergent high, correction, and divergent high, most likely a correction to come. But those divergences, we'll see. We're still in an uptrend for now, and I don't see any sell signals right now here on the intraday or the daily chart. This is a daily chart, other than that little, that's not even a clear breakdown. That's not a great trend line. Let's just move on from healthcare, go to the next one. Financials. Financials are interesting. Okay, next up, financials, and this is an interesting sector. Somebody inquired about them recently, and I made some comments. They have been dead money, and I think they will. You see a lot of lines in the chart, so I'm going to turn these off in a second to show you what stands out to me. This is the, believe it still depends. Let me see, XLC. Last I checked, yeah, it was the third, about equal with XLC. Maybe XLC, the communications sector, might be a little larger now, but so call it the third or fourth largest sector. So when I turn all the lines off, what I see is a sector that has long since kind of peaked out here. A lot of the trades occurred. We had a trading range here, a brief little V bottom whipsaw below. It got back in the trading range, went to the top, fell to the bottom. Once we broke the bottom again, another V-shaped recovery, but back. But what's happened this time? Every time we hit the bottom of that range, that box there, we've been checked. Now, my comments were, my reply when someone asked about financials, I think they're going to be dead money for a while. I think it's a dead sector. BKX is the banking sector. Remember, financials, XLF has insurance companies and other, mutual fund companies, money management companies, things like that in there. BKX is more of a pure play of the banking sector, and you can see the banks are not doing well, and that says a lot to our economy. Our economy, other than the big heavy tech sector, really the whole machine is built around the financial system and the banking sector. And just to digress for 1 second from a fundamental perspective, I read the headlines. A lot of the big banks came out and actually beat expectations, and that was being cheered because that's never happened during a recession. Number one, make no mistake about it, we are in a recession. You can go to GDP, pull the GDP charts, 2 contracting quarters. We're in a recession. Although there's been a big abatement in things like unemployment claims, new claims, and all that, again, we are at elevated levels. We're at recessionary levels. Never before in history, at least not in my lifetime, have we been in a recession and seen the stock market anywhere near or above, at all-time highs. This is crazy. Again, I've said it many times. The Fed went completely nuclear in their response to COVID and flooded the system with money. And now to digress, what happened with the banks is, I read all these, the earnings. The only thing that put them profitable is their trading desks. They're gaming the stock market because the Fed gamed the stock market. They've created a lot of activity there for them. The banks aren't making their money. They're not beating expectations or making their profits from traditional means such as lending money out and capturing spreads between what they're paying on their deposits and then what they're making on their loans. That's how banks traditionally made money. Now you go all the way back, read on history, back before the crash of 29 and the Great Depression. The reason that got so bad is because back then the banks were allowed to game the stock market and they had their hand in the cookie jar. And when the stock market collapsed, the banks failed and they had to run on the banks, and of course we had to bail them out. Then they set up Glass-Steagall, which separated banking from brokerage. They couldn't, banks could no longer game the market with investors' money or depositors' money. And then gradually Glass-Steagall was repealed and broken down. And so we're back to where we were pre-1929. Of course, yes, I know different checks and balances in place. But again, the point is that, the fact that banks are making money almost solely because the stock market has been going up because of what the Fed has done is, to me, not a healthy sign under the hood. Just imagine now if we get a big correction sometime after the elections or in 2021, and that takes away that pillar of earnings from the banks. Not gonna be good for the banks. But say what you want about them. Again, here's BKX. I just gave you my fundamental thoughts on that. BKX is mostly traded in this range, a little V bottom break below. Same thing, we fell below it, back tested the bottom of that range, and we're still well below it. So the banks, again, to me, have been and will be dead money. There's zombie banks, just like they were back in Japan during their the beginning of the lost decade or throughout the lost decade. And I think that's what we're going to continue to see going forward for some time to come. And if you want to look at XLF on a longer term view, this is a weekly chart. The most salient levels to me or things to note on this chart are right here. You have an uptrend line. This comes off the 2011 lows. Quite a few reactions. I'm marking those here and here and here. Fell to that level right there. It was a big level. We paused. We had a reaction, then gap down below during the meltdown, the COVID meltdown. And then look, a perfect back test and a rejection. We're back below that level. So we're below the primary uptrend line. This is our bull market uptrend line since the 2011 lows. We're below it, so this is a bear market. It's a bear market for the financials. They're still well off the highs. That high, it wasn't just a random high. It was a big divergent high, negative divergence that had been building. So you can blame it on COVID, or you can say the technicals were pricing in a big trend change, and that COVID just helped it along. And that's where we're at. So from a technical perspective, say what you want, but I'd say this is pretty bearish. And then if I turn off all the, I can leave the lines on. I'll just show you a box too. There's that trading range. This is where most of the time, most of the last couple years, really all the way back to 2017, this is where XLF has spent most of its time trading with that brief breakdown. That one recovered, got us back in the range. This time when we broke down, we tried and we were rejected, and we're still below the range. So look, we're not far below it. You want the bullish case, you need to get in the range. If we enter the range again, history tells us once you enter a trading range, or the odds say, you're going to run up to the top of the range at least, and that would be, longer term bullish scenario. Maybe this was the fastest bear market in history, and maybe it's over. We'll see. Time will tell. But as of now, you can see my trend indicators. Love this 9 EMA at various time frames. We're on a weekly time frame here, and it does just as good a job as it does on the daily or the 60-minute chart. And again, you look at the 9 EMA because that's the last of the two to cross. That says bearish trend. Get out of your longs. You're in a bear trend. When it crosses back over, it says bullish trend. You can be long all this way to right here. And then you crossed over, bearish trend. Caught that? Bullish trend. Okay, so you can see anytime you're above, the red boxes show when we cross below, and it captured in recent years all these bearish trends. Some last longer than others, and right now we're in a bearish trend. So if we can break above, if the white line makes a solid cross back above, that's going to be bullish. It's going to flip this trend indicator back to bullish. But quite often the zero line will act as resistance when tested from below, and so if we are rejected here anytime soon, that's going to keep that trend bearish. So that's what I'm looking for. Bigger picture. Again, this is a weekly chart. You're not going to have any change at the end of this week or even next, most likely. This is something we just have to monitor over time. Okay, just a couple more. We'll wrap it up here. XLC communications sector. Last time I checked, this was again about the third or fourth largest, about 10.6% weighting in the S&P 500. This sector, just two companies alone, Facebook and Alphabet, make up about 44% or nearly half of this. So you don't need to bother with all those low-end components, which are Fox and Discovery. A lot of those companies in there, they're not going to move the needle. It's Facebook and Alphabet that are going to move the needle on this one. And you can see from a charting perspective on this daily time frame, there was our primary uptrend line. It was nice and clean, lots of reaction, big bearish rising wedge, negative divergence confirmed, at least there on the PPO right there. We had extreme overbought conditions on the RSI. Breakdown, and we hit that. That was a big support level right there, 56.78. Why was it big? Well, it was a previous all-time highs here. We failed before the big COVID drop. Tried to get it again, failed, rejected. Tried again, rejected. Finally, we broke out. Back tested for a while. Once we saw that level would hold, this resistance once broken becomes support. Boom, off to the races. Back to down there, back tested. So kind of bigger picture is we had a breakout of a very significant level. This was a breakout to new all-time highs right there. We rallied, and then we've just recently back tested the breakout again, and so far held it. So bulls want to see that was a successful back test and we're going to new highs. Bears want to see us come back in and fail the breakout, meaning we move impulsively below 56.78. Where are we now? We're in what I call no man's land. No man's land is smack between support, which is right here, and resistance, which would be that previous all-time high. So near term, well, I'd have to hone in on Facebook and Alphabet and give you my opinion there if you want to know where we're going near term. But as of now, let's just say I'm kind of neutral on that. The chart's not telling me much there. We look at a weekly perspective. Remember, this one hasn't been around long. XLC, the communications sector, replaced the old telecom sector. Forever and a day, going back as long as the S&P was around, we had the telecom sector, AT&T, Ma Bell, the old school, telephone companies, things like that. And those are, they went the way of the dinosaur now. So they replaced the telecom sector with the communication service sector with those names I just showed you there. And all that stands out here, well, you had a trend line break right there, a big sell signal. And look, that was the last time we've had a clean, this is a weekly chart, bearish PPO crossover right there, coupled with overbought conditions. So the similarities here, once again, overbought, bearish PPO crossover, which is still in effect. That blue line still below there. And the big question is that another comparable sell signal like this with a lot more to come? Is this just the first wave down, or is that it? Are we going to push back up and make new highs? Again, we're in no man's land. I just want to show you the big levels to watch. Big level would be a drop below 56.88, whereas a break of those highs depends on when it happens, how bullish it would be, because look, if it happens really soon, let's just say we rally into or after the elections and we do this and we come in there, we might have a divergent high, we might have overbought conditions again. We'll see. Like I said, you want more of the near-term outlook. You have to zoom down to the daily and even 60-minute chart to kind of get clues. And I don't see a lot. XLC isn't telling me much, so let's move on. XLY, this is consumer discretionary, and 10%, about a 10.25% weighting in the S&P 500. 1/4 of that sector is made up of Amazon, probably more than that now. I haven't updated that since June 15th. A little minor uptrend line, but here's what stands out to me. This thing's been building divergence for quite a while. Negative divergence at the recent high. There it is. Negative divergence. And we broke this minor trend line that recently cracked below it, and we're still below it right now. So, just based on this chart, look, the trend indicator is still bullish. I always say divergence in itself is not a sell signal, but it's certainly an indicator that a trend change is likely. Let's look at it here from the weekly chart perspective. And there it is, same thing. We have negative divergence right here. Divergent high. We had a divergent high here. That's what happened. Divergent high there, divergent high there, divergent high there, divergent high there, divergent high there. You get the point. Okay, we'll just do a couple more. Industrials, XLI, that's about an 8% weighting in the S&P 500. And as you can see on the daily chart, here's our divergence line, negative divergence. Pretty big divergence too, mind you. Negative divergence, last time we had it was right there, leading up to the COVID drop. Boom. So, if you didn't heed that divergence or the sell signals that came on the market, it wasn't as clear here on XLI, but we had very clear sell signals on the S&P 500 and NASDAQ 100. And again, you can see all the little divergences. They're all marked down below, all the corrections you can see that followed, just like divergent lows. I like to look for those divergent lows. That's when you want to go long. Divergent low, go long. Divergent high, get ready for a sell signal. The only clean trend line or somewhat clean trend line I had was this one right here. So, we broke down below it, back tested, had another thrust up, and again put in a divergent high. Sometimes you break down, you never look back. Sometimes you break down, you put in a marginal new high, especially if it's still a divergent high, and then you go down. Either way, you can see the levels. I'm going to move this level up right there, about 79.90. A break below that would be bearish. As long as we remain above it, you can stay bullish. If you want to stay long, if you are long, stop somewhat below. And if that breaks, I'm gonna keep this line here about 73.18. I think is a minimum target. And this is what it looks like on the weekly chart. It's a similar story to the stock market. When you back out tech and you look at a lot of sectors, many sectors peaked back here. I have little to no doubt that if the Fed, we didn't have the Fed and it was completely hands off, This is where last bull market would have ended. We had that drop in 2018. That was clear. This is where the Fed pulled a 180 from being hawkish to going completely all out dovish, caved into President Trump's constant whining for Powell to do so. He caved and started flooding the system with uber low rates again. But you can see there's a pattern here. It's like a market that's topping out. Here we had a near a triple top. That was a failed breakout, by the way. There's our big level. It's around, give or take, 81, and that's where the industrials for years now have been failing. And then they had a breakout. And that breakout, this was a clear bearish rising wedge pattern, and it broke out to new all-time highs, and the breakout failed. As I often say, breakouts that occur with negative divergence and overbought conditions typically fail. They have a much higher rate of failing, and that's what happened. And also, fewer things are more bearish than a failed alongside or bullish breakout, and there was our big drop. So we're right back to where we started. We're right back to where we've been checked every time going back to late 2017, early 2018. Now it's a big resistance level, so I do have to say a solid break above there. If we can break out, we don't have divergence anymore. Well, we could do if we extend this line, but no divergence on the PPO. We can get a solid breakout and take out those highs. That would be bullish. Otherwise, look for another rejection here, and that's going to be bearish, and you can see these would be your downside targets. XLP, consumer staples. This is a defensive issue sector that usually you'll see money moving into when institutions are, think there's going to be a turn in the economic cycle. And they've been doing pretty well lately, reflecting that, concerns about the economy. Little minor uptrend line right there. Bearish PPO crossover right here that led to that drop, and now we have pending. It's not yet happened, but if we go down much lower, we're going to get another bearish PPO crossover right there. And it's pretty much the same. We're kind of stalling out here so far around those, just below those previous highs. And let's look at it on the longer term chart, weekly chart. That's what it looks like. I don't want to spend a lot of time on this chart. Let's look at energy and we'll wrap it up. Energy is just a dead sector. The energy sector peaked years ago. This is XLE, peaked back in 2014, and it has been and remains in a vicious bear market since. It used to have a much higher weighting on the S&P 500. It doesn't move the needle anymore because these companies are not. They're just a small shell of what they used to be. Big oil, Exxon Mobil, Chevron Texaco, things like that. So there it is, guys. Long video. There's your breakout. If you remember the beginning of the video, that's a pretty impulsive candle. That's near-term bullish, and that opens the door up to 289.42 as long as that breakout holds. So if you went long, you just set a stop below, maybe below the bottom of that 60-minute candle right there, today's candle. Fall back into the range, maybe a little bit more. It all depends on where you think this is going. That's, again, I throw out suggested stops. An active trader would have a tight stop, whereas a swing trader looking for a move, maybe a back test of the trend line or a move to new highs and beyond, can use a much lower stop, even below that 280.32 level, somewhere around there. All right, we'll wrap it up here. I'll get it out to you guys. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.